Welcome back, investors. Ticker Time News. I am Adam, and after yesterday's live stream and the decisiveness that I had, I went digging for data to figure out where is this market going to be headed. And I came across this data right here on Twitter. And what it boils down to is that the most bullish day of the year over the past 21 years is July the 1st. And this July 1st was definitely a bullish day. I just wish I would have come across this a day sooner, so I could have shared it with you, and we all could have printed some attendees today. All right, besides this wonderful document showing that it's a very bullish day, it also shows that the Tuesday, or the first day the market is back in session after the 4th of July, is typically a down day. So we have that to look at too. Now, the stock market definitely showed resilience to selling today, and that was despite some relatively bad news this morning. S&P 500 on the chart. And remember, you can do this at home as well. There is a link in the description of this video to TradingView. Click on it, and it will take you to TradingView. Sign up, absolutely free, doesn't cost a penny, and you can chart right along at home too. 15-minute chart I want to show you here on the S&P 500. You can see that from yesterday's close. So here we go. There's two boxes here, right? The volume at the bottom shows you the beginning and the end of each day. So we got 2 days here, yesterday and today. And to make it a little simpler, right here is that break even split line. Yesterday, we dipped down in the morning, rallied, and then kind of sold off. Today, we opened a little high, dipped down in the morning, but then right about 10:45 a.m., we rallied for the remainder of the day. Now, we closed today above the 3,800 level, which is very key and very important. Then, if we look at today's high, which was basically where we closed, right? The last 30 minutes of the day, we were at 38.29 for the highs for both of those 15-minute sections. But if we go back to the day before yesterday and we look at that high, it is right about where we are now. That high for that day would be 38.30. And we were at 38.29 today. So that level is going to be a key level that looks to be forming a bit of resistance. 38.30 on the S&P 500, which would be about 380 on the SPY. We're getting some resistance built up right there. So that's the one negative that I want to point out. Today was positive with the little rally that we had. It was a whole percentage point, right? So we have that to look at. We also have this 38.30 level. If we look back here a few trading sessions ago, where we had this gap up in this section, the bottom right there is real close to that 38.30 level. So the gap has been filled. That's not what I'm worried about. But what I am worried about is resistance building right along here at this level. And you can see it on the chart here. 38.30 for the S&P 500, 380 for the SPY. It looks like resistance is building. And if that data that I showed you about today being the most bullish day of the year, and that the day following July 4th is a negative day, then we could be looking at resistance here in a ceiling, and then we could pull back from this position on Tuesday when the market is back in session. All right, we got that. Now, each of the major indices, they stuck to a fairly tight range at the beginning of the day before buyers stepped in, leaving the S&P 500 above that 3,800 level that we just been talking about, right? Well, the S&P 500 did close down for the week, 2.2%. The Nasdaq, let's pull that up. First, let me clean the chart up real quick. Take these lines back off. All right, let's go look at the Nasdaq. it finished the week down, and that's mainly from the big drop that we had on June the 28th, right? That's where all the losses came in, because the past couple days, for the most part, have been relatively flat. All right, so we filled in this gap down right here, so that's not a worry on the chart. Resistance-wise, we're kind of making lower highs and lower lows on this 15-minute chart. So even though we popped our head up right here today, at the end of the day, it is still lower than this group, which was lower than this group right here, which was then, of course, lower than this group. So lower lows on the highs. And as far as lows go, well, we haven't undercut that low, and we made a higher low. So we could be getting into a bit of a wedge pattern here on the 15-minute chart for the Nasdaq, which means price action would be tightening, meaning price wouldn't move as much, meaning that we could end up getting a breakout. Now, going to the daily view, you can see we are in this falling wedge pattern, and we're getting really, really close to this resistance line right here. All right. So we're almost at that point on the chart. Let's bring it up a little closer. So the theory, or the data that shows the day after 4th of July being a negative day, well, I could see that building after today's rally. Just want to point that out. So the Nasdaq was down 4.1% on the week. The Dow Jones, that was down 1.3% on the week, but it was up 1% today, which was really good. The Nasdaq was really the underperformer. It was up 0.7% on the day. And if we look at the Dow, it's also getting close to, but not really, this resistance line here, which I'm going to say is right at that 50-day moving average at this point. So it's got some room that it can go. It seems to be using that 21-day moving average, though, this closer one right here, as its actual resistance line. So again, I could see a negative day forming for Tuesday. But then again, one thing to remember, even though the data says, and let me put that back up, it points to today, S&P 500, for example, out of the past 21 years, it says that July 1st is up 85.7% of the time. That's pretty good odds. The Dow Jones is up 76.2% of the time. And the Nasdaq is up 76.2% of the time as well. So very interesting data indeed. So if it continues and we do see a down day on Tuesday, well, then you know that that data is looking pretty darn good, right? The one thing that I wanted to add, though, to that is on Tuesday, and let me go back to the S&P 500 to demonstrate this. I'll put volume back on. Oh, it's already on the chart. Okay. If we notice volume down here, okay, let me do this real quick so we can see it a little bit better. Volume was down today, all right, below average. And I may have the market internals that I can actually see what, let's see, market internals. There we go, market internals. Lower than average volume today. New York Stock Exchange, 929 million versus an average of 1.18 billion. And you can see that right here on the chart, this volume, and I didn't mean to make a heart, but I did there. You can see that the volume, the blue line here is the average, and volume was underneath that average right there. So it was lower volume. Now, on Tuesday, we could come and kick off Tuesday, and volume could just boom because everybody's back from their holiday weekend. I'm sure a lot of fund managers took today off, which obviously we can see that in the volume for today being down just a bit. Now, as we move on, the Russell 2000, right? It was up 1.16% today, which was the best, right? Small caps did a great job today. one thing cool about this is small caps actually ended the week in the positive, right? They were up 0.45% on the week, while the other three major indices were down on the week. So good job, small caps, for the week. You did great, and you owe it to today. Even yesterday wasn't that bad. Pretty flat day, though. Okay, let's keep moving on. Now, the market closed definitively higher ahead of this holiday weekend, despite some key factors that came out this morning that were negative, right? Number one being Micron. Ticker symbol is MU for Micron. They were down, let's see, how much today? A couple percent, 2.95%, down another 0.1% in the after hours. They're just getting pummeled right now. But Micron came out and issued fiscal Q4 revenue and EPS guidance well below expectations, citing a weakened demand environment from smartphones and PCs. So are we not upgrading our smartphones this year? What it seems like, right? Number two, General Motors, ticker symbol is GM. They reduced their Q2 net income expectations. However, they did leave their full year guidance unchanged. And they cited the reason for this is supply chain disruptions that adversely impacted wholesale volumes in Q2. And then three, and this has nothing to do with the United States per se, but the Eurozone had a record high inflation rate, 8.6% year over year in June. That's pretty bad. And number four, the June ISM manufacturing PMI saw its lowest reading since June of 2020 at 53%. And the first contraction in new order activity in 25 months. We're in a recession. We keep saying it. We just need the proof, right? And number five, cryptocurrency. Man, Voyager Digital. It had to happen, didn't it? Voyager, cryptocurrency brokerage, Voyager Digital. They had a bad day today. And they trade on the OTC. So we can't trade it here in the States unless you have access to the OTC. Their shares tumbled nearly 30% today after it decided to suspend trading, deposits, withdrawals, and loyalty rewards right about 2 p.m. Eastern today. Voyager Digital's CEO said it was a tremendously difficult decision. Yeah, I bet it was. But they believe it's the right one given the current market conditions. Now, the decision gives them additional time to continue to explore strategic alternatives with various interested parties while preserving the, quote, value of the Voyager platform. Now, what could happen there? Voyager Digital suspending everything because they want to preserve the capital that they have, which is down significantly. We're talking hundreds of millions instead of what they were valued at when Bitcoin was at its high of over $1 billion. So they've taken a big cut. Now, they want to preserve their platform, so they're stopping people from putting money in, taking money out, doing any trading to preserve that capital so it looks better to a potential buyer. But I'm sure there's a lot of potential buyers out there that know, you know what, doing this to your customers means once you unfreeze their accounts, look at Celsius. A lot of them are going to try to leave as quickly as possible. So if you have money in Voyager, just be careful, be vigilant, pay attention, watch for any notices, maybe put in a Google search alert for anything related to Voyager Digital. I just kicked off. You got to be careful what you say when you have Android products. Yeah. All right. Now, buyers did step in the stock market. In the crypto market, they have too, because Bitcoin today, let's see, where was it low? 18,938 was the low. The high was 20,879. So let's go to a 15-minute chart. Buyers stepped in. I'm curious how it played out here. So the low today was about 7 o'clock this morning. The Voyager news didn't really hurt because Bitcoin's basically been trading in a very tight pattern since 2 o'clock Eastern when that news came out. So a big rally in the after hours with Bitcoin yesterday, and then profit taking, selling into strength. It's something we've seen over and over again. Bought 2 NVIDIA calls for Tuesday. Well, I'll look at NVIDIA's chart. We'll see how that looks. We'll see how that looks. All right, so Bitcoin, yeah, sold in the strength. That's what the big rally overnight occurred. And you know what? A lot of times in that overnight trade for Bitcoin, there can be some pretty steep action, right? I definitely see that. Anyways, I'm waiting for Bitcoin to potentially get a little bit lower, 16,000 maybe. And then I'm going to make a little purchase slowly, because if it continues to come down, I want to make sure that I can take in some of that Bitcoin as it goes down to lower my cost basis for Bitcoin. Now, for Ethereum, it's holding up rather well, quite frankly. It's been up above this $1,000 level. Let's see, yesterday's low was $997, and it closed it closed yesterday. Let's see. Bitcoin and Ethereum crypto market doesn't close, but when we get to overnight, $1,000. It's really been holding up, even though it dipped down to a couple dollars under 1,000. If we look at Ethereum, it has really been holding up really well since breaking above 1,000, going back to June the 18th, right? So Ethereum has been looking a lot stronger than Bitcoin over the long term here. So that's impressive for Ethereum to be able to hold up above that $1,000 range. That's pretty cool in Ethereum. All right, let's look at NVIDIA right quick before I continue on with the market here. NVDA. I know it dipped down into my buy zone today, sub 150. I did not buy any. As you know, I believe it's going to go lower. But if we look at this line right here, let's see. I'm going to take volume off to kind of clear it up a little bit. Zoom in. We've got this area right here. And call options look like a smart move. Although, one of the points, though, with Micron, the semiconductor industry, it finished the week down nearly 10%. It has just been struggling for a while now. But dipping down right here, this purple trend line that you see coming across here, it's had many reactions on it. It's not really anything except for maybe a guidepost, right? Because price action goes way above it, way below it. But it dipping down sub 150, that's a pretty low area. And then, of course, it bouncing off of this trend line area. Let's go to the 15-minute chart here for NVIDIA. A little lagging there. All right. Turn volume back on. Yeah, it looks like quite a few of investors were stepping in, even though it was lower volume today. There was more selling going on. It looks like right around the 145 price point. today. Definitely 145. There were more sellers stepping in than buyers, strangely. But there's a lot of action at that 145 price point, and that's why price action basically hugged that line all throughout the day. Let's see here. It looks like selling at 146, buying near the 145. So very, very tight price action right there. If we take that into consideration with the past several days, I mean, it has just been down, down, down. And the last time it was on this trend line here, it dipped below it, it rebound, dipped below it again, and then rebound. So every time it has dipped below it, recently, that is, we can see that obviously right here. It rebounds heavy the next day, right? And then again, it dips down underneath here and it rebounds heavy the next day. As a matter of fact, gap up right there and previous gap up. So it is definitely less risk taking call options right here. Definitely less risk. So your risk reward should be adding up to a pretty good calculation right here. I also took some bites at some shares at 144. Yeah, that's not bad. That's not bad at all. Not bad at all. So I think you're doing good there. I really do. I think you've got some a call option that should work out fairly well for you. As long as it stays above this purple line, right? This purple trend line that's coming diagonally across the screen. If we look at the beginning of the year and the end of last year, it really acted as resistance, keeping NVIDIA going down and down and down. But it has changed slightly in the recent history that we just talked about, with this turning into a support area, right? Or support-ish, since it did dip below it just a little bit. So as long as you don't get stopped out, you should be all right with that one. All right, let's keep moving on. Okay, so buyers stepped into today later in the day, and we can obviously see that on the 15-minute chart on the S&P 500. Go in a little tighter. You can obviously see that right there, especially at about 1 o'clock in the afternoon-ish. That's when it really started to march higher. But early on, there was not much conviction on either side of the trade, with decliners roughly in line with advancers at both the New York Stock Exchange and the Nasdaq. At the close, however, and this is the complete opposite from yesterday, advancers led decliners by a greater than 3-to-1 margin at the New York Stock Exchange and roughly a 3-to-2 margin at the Nasdaq. The rebound accelerated in the early afternoon, shortly after the Atlanta Fed released its updated GDPNow forecast for Q2 GDP, which now says Q2 GDP negative 2.1%. So a 2.1% contraction. That's down from its previous forecast of a 1% decline. So it's over double now what they previously forecasted. While the forecast is now calling for a sharper contraction, it will also fuel speculation about the Fed halting its rate hike cycle sooner than previously thought. Maybe even a Fed pivot, which would send this rocket, boom, to the moon. If the Fed did a pivot, meaning they halted rate hikes, they halted quantitative tightening, that would be a fire to a firecracker, right? Launching that thing off. The market would just shoot up. Every time the Fed does a pivot, it affects the market. If we look at the S&P 500, I'm going to go back to the daily view here. When the market started to roll over, why did the market start to roll over? Back here in this area, why did the market start to roll over right here? Because the Fed started to talk about tightening, quantitative tightening. The Fed started to talk about inflation being out of control. The Fed started to talk about rate hikes. That's when the market rolled over. So whenever the Fed does a pivot, the market reacts. Quantitative tightening, the market's going down. Quantitative easing, the market's going up. Rate hikes, the market's going down. You take those away, you stop them, or even you lower rates, the market's going up. So, could the Fed pivot? Well, I don't know if they will in July, but it does leave the door open in September for sure. Now, this effort left all of the 11 S&P 500 sectors in the green. I'll pull that up here on the right-hand side of the chart so we can see them all together. Look at that. All of them green. All of them. Best performing, utilities. Best performing utilities. And that is a very defensive sector, right? People go on utilities because they are all very, I guess what I should say is utilities are not as volatile as other sectors in the market. It's very stable. That's why it's a defensive sector. People want to park their money there to keep it safe so they don't lose it. Now, the leaders, besides utilities, which was up 2.5%, consumer discretionary, up 2%, real estate, up 1.9%, and energy, up 1.4%. At the bottom of the pack, we had information technology, still up 0.3%, materials and communication services, both up 0.7%, and industrials, up 0.9%. Now, the late session buying mentality could not save the semiconductor stocks after Micron's warning. The Philadelphia Semiconductor Index, ticker symbol is SOX. And in TradingView, you want to make sure that you get the right one here. I usually use the TVC, unless I want to do some different type of charting. But it was down. It was down 3.83% today. And it just keeps falling. We talked about this earlier this week, and we talked about this top right here and how it's, if we were to try to make some sort of a trading channel, it'd be kind of hard because that bottom line, if we try to put a bottom line there, it's not quite straight, right? It's not quite equal to the top. But with this top right here, the one I highlighted, we could probably draw a line right down the middle of this channel, and that's right about where the semiconductor index stopped. But now it's at this low area right along what we could possibly call a trend line. It doesn't have the same slope, and it doesn't have as many contact points. I mean, I've only got 2 touching it right now. And you need 3 or more. So whenever you're doing trend lines, 3 or more. Let me go in here and let me try to do this proper. Let me clone this, because for trading channels, you really want the same slope And if I line it up right here, we have not the wicks as the bottom point. We've got close of a group of candles. Let's see, 1, 2 right here, and then a third wick touching it. It skips it the rest of the way down until we get close to the bottom, and then we have 2 wicks touching there, and then we have today's closing candle touching it right there, landing right on the line, closing right on that line. So doing call options on semiconductors, this is obviously a low place for a risk or reward. But the thing to remember, and why I think it could still be going lower, is if I'm going to take those marks off there. Right here, we're making, that's our high. We make a lower high, a lower high, a lower high. We're underneath the 3 major trend lines, 21-day, 50-day, and 200-day. That's bearish. We're also making lower lows, right? Lower lows all the way down. This is still a very bearish setup right here. Very bearish. All of these indicators point to that. And that's the point that I want to get across, that we are still in a very bearish setup and territory for semiconductors, even though we've kind of hit a bottom that we have bounced off of at least a handful of times. So with the Philadelphia Semiconductor Index, it was a notable weak spot today, and it closed down 3.8%, like I mentioned. But that widened its weekly loss to nearly 10%. And many of the index components set new 52-week lows this week, including Micron. Other stocks that reached new lows are NVIDIA, that we talked about already, Intel, and AMD. This contributed to relative weakness in the information technology sector. Otherwise, the sector might have finished in one of the top 3 spots. What do you think of JP Morgan at these prices? It all depends on the Fed, to be frank. The Fed's gonna determine where bank stocks go. At the beginning of the year, I was really on board with regional stocks, regional bank stocks. I thought they had a better chance this year than, say, big banks. But JP Morgan, I think, is a good big bank. I also like Wells Fargo. I know Wells Fargo had some shady history, but they're moving past that. They're transitioning nicely. I like Wells Fargo as far as big banks. When it comes to Bank of America, a really big bank as well, I'm on board with that too. I think that would be my top 3 in big banks. JP Morgan, Wells Fargo, and Bank of America. All right, this level right here for JP Morgan Chase, if we look at that, we can see there's a lot of price action in this space. All right, let me add. All right, here we go. Let's see. Right about 110, right? Put a line right there, this red line. 110, we've got a lot of price action in that spot. So it's about where it is now. I'm set at 114, so $4 away. We had this gap up to this level. So if JP Morgan breaks below 110, it's going to go all the way down to 104. because there's a gap here that has not been filled. That would be my very first thing that stands out. Is back here, November of 2020. Okay, we have got a gap from 110 at the top, and let's see, the bottom here, I guess it's 105. 105.10. 105.10. So that gap still needs to be filled. So I think if JP Morgan dips below 110, which it's marching in that direction, then it's going to go to 104, 105 area, maybe find some support there. But that's my first thought. So I'd be real hesitant right now. I wouldn't want to buy it at 414 or 412, maybe even 410, depending on how it holds up at that line. Because I know that it's going to fill this gap if it breaks to 110. So that's the first thing. Second thing is that 110 area has a lot of reactions, and I almost need to put a zone with a low probably around that 105 mark as support. And then the 110 area, I'm not going to call that support. I'm going to say if it breaks below that 110, it's going to go find support here at this 105 area. So if we go back all the way to December of 2017, we're not even talking 2019 theory here. We've got a ton of support right along this line, and I think it could hold up again, and I think that would be a really, really good place to enter at 105. A really good place. If JP Morgan broke that, and let's go back to 08, 09, where we had the financial crisis, and I just want to see how it reacted there. As a matter of fact, I'm going to change this to a weekly chart. It is lagging a little bit today. I wonder why. It's been doing good the rest of the week. All right, let's see. 2008, 2009. Okay. So obviously well below this, but I just want to see how it acted. So the decline came real soft and then real heavy. So that decline, real soft and then real heavy, and almost a V-shaped recovery there, but it still took it a long time to make that back. To get back to its high of 2007 right here. It took all the way to, what would this be? That's not even that high. So it took all the way to 2013 to set a new all-time high. So 2007 all the way to 2013 before you turned over a profit, if you bought it that high, obviously. So after the financial crisis, it really bounced around a lot before it got its legs again. And this is a weekly view again. Okay, so our conditions today, I mean, it's not, fall soft and fall hard. This has been a hard fall, just straight down. All right, so I'd hold that 104 as a great entry point, at least from recent history here, and then, play it from there, see how it reacts. So that would be my thought on JP Morgan in the short term. Okay, let's keep going. Let's talk about treasury yields, because we're talking about banks here, so it makes sense. Treasury yields were another big story of today. Many thought, with the sharp fall that treasury yields saw today, that the bond market was starting to price in a Fed pivot, which I found that to be really, really interesting. But there was something else that occurred right on the heels of the June ISM manufacturing index. That's when treasuries fell sharply. So I'm wondering if the ISM manufacturing index might have done something to the treasury market, because there's a little timing issue there that I think plays in. But the treasury market did settle at session highs or intraday highs today. But the 2-year did fall 10 basis points today. US 02Y for the 2-year, and you can see this. That's a weekly time frame. Let's go back to the daily. You can see that candle underneath it, and we're talking about this support area here. While the wick broke that little support area, the candle itself didn't. It closed right in there, okay? Now, the 2-year got to 2.83%. That's where it closed at. You could round it up to 2.84% right now if you wanted to in the after hours, so up just slightly. But today's high, intraday high, was 2.86, so 0.3% higher, not far off. The 10-year today, it fell 8 basis points to 2.89%, so 0.3% away from an inversion of the 210 spread. That's pretty close. That's getting really close. 10-year US 10Y for the 10-year yield, and it just completely just broken down, right? Just completely broken down. But it did come off of its bottoms early on. Now, its intraday high was 2.9% versus its close at 2.89%. All right. Now, speaking of the June ISM manufacturing index, it decreased by 53%. Expectation was 55%, and that's down from 56.1% in May. Now, a number above 50 means expansion, and a number below 49 means contraction. So the market has expanded for 25 consecutive months in the manufacturing sector. Although the June reading was the lowest reading since June of 2020, so 2 years ago. I think the takeaway from this is that it refers to a clear slowdown in manufacturing activity, highlighted by the first contraction in new order activity in 25 months. That's interesting, right? Let's see. Do you really think the Fed pivots with inflation this high? I don't feel things have come down. Okay, there's 2 answers to this question. And let's just do this so we know what we're talking about. All right. Part 1 of 2 parts of this answer to this question. Number 1, no, I do not think the Fed will pivot. Not in July. I do not think so. September, the door is a little bit open, at least for maybe a 25 basis point instead of another 75 or another 50. Maybe they come down in September. That's a possibility. The door is open for that. So July, I really don't think so because inflation is high. Now, the second part to this answer is commodity prices typically lead the way, right? And commodity prices have come down significantly this past week and over this past month. Like nearly everything is in the red. Let's just use oil. Oil is one of the big ones, right? USOIL. Get the cursor here. USOIL. WTI crude oil. Let's just look at that for a moment. Let's look at the weeklies here. This thing has almost has a reversal candle here, right? Almost. It is still outside on the weekly. It closed up just a little bit, 0.8%, 0.9%, you could call it, but it's still on the outside of the bottom support area of its most recent price channel, right? So it has come down. And if you look over the past 3 weeks, right? Over the past month, oil over the past month has come down quite a bit. From highs of 123, 123 again, down to 108, and yesterday's low of $101. So oil as a commodity over the past month has come down substantially. And this is across the board. Nearly every 90% of commodities have come down over the past month. And that's one of the very first things that will indicate inflation coming down. It's like the most leading indicator you could get on inflation are commodity prices. Now, that doesn't mean that inflation won't remain elevated, right? Inflation could plateau and it could just gyrate in between, you know, 0.1%, 0.5% move month over month, or even the year over year number. So inflation could remain elevated. But if inflation is plateauing and it comes down 0.1% in July from last reading, and last reading was high, going back to March highs. And then say August, it comes down 0.2%. Then maybe September, it comes down 0.5%, right? Inflation would still be elevated even with those tiny little incremental declines going June, July, August, September, right? At that point, the Fed may say, okay, plus a second part to the second part of the question, GDP, if Q2 GDP really is contracting 2.1%, which is greater than the 1.6% contraction from Q1, we're technically in a recession. And if inflation between now and September meeting starts to come down, even just little tiny increments from now to September, July, August, and September's read, so we get 3-month reads there, and we're in a technical recession because Q2 GDP is 2.1% contracted, the Fed could pivot in September if that was the case. And if commodity prices continue to come down. Now, remember, the biggest area in the bond market that the Fed looks at for trouble with the economy. And one other part too. This is actually this. It's a multi-part answer. My apologies. I'll try to sum it up here in just a moment. Remember, we got a 10-2 inversion, right? The 2-year and the 10-year yields, they inverted in April. They're 0.3 away from inverting right now. But the Fed doesn't really look at that as a big deal. It is a leading indicator, and it does say, yeah, we could have a recession in 12, 16, 18 months. But I think we're in a recession now. And what the Fed will use is the 10-year and the 3-month. That's the one they look at the closest for inversions, right? And if we do the 10-year, which is US 10Y, and in TradingView, you want to divide that by the US 03, 03M for the 3-month, and we look at that, it is coming really, really close to being inverted. Really, really close. And that's what the Fed will look at with the biggest weights, right? The 10-2, not as much weight. The 10-year, 3-month, a much bigger weight. So if all of these signs are showing, and another thing too, my apologies. The Fed, at least the Fed chair, Powell's already said that fighting inflation is the biggest mandate they have right now. As a matter of fact, it's their only mandate for the most part. Employment is their second mandate. But inflation and bringing that down is their number one mandate. And that's what they're working on. And Powell has said that he's okay with bringing inflation down into a slowing economy. But if that economy is already in a recession and contracting at a greater rate at 2.1% for Q2, and let's sum this up. So we have the Fed, we know inflation is a mandate, bringing that down. And we see commodity prices coming down, and they keep coming down from now to September. July, August, and September, commodity prices come down. Also, July through September, we get our Q2 GDP reading. And if it's a negative number, that means we're contracting and we're in a recession. So falling commodity prices in a recession, they do a 75 basis point rate hike in July. And then the housing market, because mortgage rates keep going up and up and up and up and up. Remember, August, there is no meeting. So unless they call an emergency meeting, there will be no rate hike in August. So we'll have that whole entire month for the market to work its way through whatever rate hikes have been done already this year. So if the housing market then continues to slow down like it is right now, we're seeing houses on the market longer. We're seeing the houses that are on the market reduce their price. Not seeing as many bidding wars, seeing many, many different indicators pointing to the housing market slowing down and saying the housing market, the bubble is letting some air out, right? So all of those things work into the favor of the Fed cannot continue to tighten like it has. And if it pivots from that hawkish stance that it's had all year so far, and let's just say that July, they're still hawkish and they do a 75 basis point rate hike, then we could see the Fed pivot in September. If not, maybe later down the line, maybe December. But it's a possibility in the door now with the Q2 GDP being shown to contract, commodity prices coming down over the past month. It leaves the door open in September for a potential pivot. But there will be no pivot in July. Inflation is still too darn high. So I know that was a long-winded answer, but I hope that I hope I was able to break it down an easy way to understand. Let me know if that helped. So no Fed pivot in July, but the door is slightly open. There's a crack for September. Not a guarantee. All right. What else did we want to talk about here? Anything else? I know it's a Friday evening. I know it is a July 4th holiday. I don't want to keep you long on a Friday evening. So maybe we could wrap it up now. The only thing that I wanted to add was that the market is closed on Monday. So let's not forget that part. Okay, wonderful. Awesome. Beautiful. If you could, a great way to help out the channel is to click that like button, share the video. That also helps. And if it's your first time watching, click subscribe. Only takes you a second to do, and it helps out the channel greatly with that crazy YouTube algorithm that everyone talks about, right? And then, of course, if you want more of this perspective daily and throughout the day, then click the first link in the description and come join us. I'd love to see you there. All right. Well, we can wrap up this live stream and go have a wonderful weekend. And I'll see you back here Tuesday after the market has closed, and we can talk about anything that you would like. All right. I'll just give you a minute or so. If you have a question, I don't want to cut off the live stream while you're typing. Wonderful. Have a wonderful, wonderful, wonderful 4th of July holiday. Let those sparklers shine and those fireworks ignite the sky, right? All right. Thank you, everyone, for joining me today. I greatly appreciate it. And again, I'll see you on Tuesday after the market closes. And Patreon members, I'll see you guys throughout the weekend, maybe with a couple of updates. And again, on Tuesday morning. Okay. Thank you. Have a wonderful day. Have a wonderful weekend. And have a wonderful and happy 4th of July. Take care.